If you're an investor here in Asia, you've probably looked at the startup world and seen some valuations that just seem mind-boggling. So today, we're going to pull back the curtain on those numbers. This is your guide to really understanding how startups are valued. All right, let's dive in.
This is the question, isn't it? It's the one that trips almost everyone up. It just seems to defy all logic. You've got a couple of founders, maybe a slide deck, and poof, they're somehow worth millions. We're going to break down exactly how this happens, and more importantly, what it means for you. You see, the trick is to think of a startup's valuation not as some static number, but as a story that's constantly evolving. It changes, and it changes dramatically as it goes from just an idea to a real revenue-generating machine. Let's walk through that journey together.
And this really gets to the heart of it. At the very beginning, you can just forget about your complex spreadsheets and your financial models. It's not about that. It's way more art than science. It's not about the numbers a company has today. It's all about the story it's telling and the potential it holds for tomorrow. It's a bet on the future.
So let's start at the very beginning, with the pre-seed and seed stages. At this point, investors are betting almost entirely on the founders and their vision. This is the art part of the valuation equation in its purest form.
So, picture this, the pre-seed stage. A company might have nothing more than a prototype, or what we call a minimum viable product, an MVP. There's probably little to no revenue, and the team is tiny, maybe just 2 to 4 people. This is the startup as just a raw idea, taking its very first steps into the world.
So without any real financials, what are you looking at? Well, you're betting on the jockey, not just the horse. Is the founder resilient? Are they a fast learner? And then, how big is the potential market they're going after? We call this the total addressable market, or TAM. Are there any early signs, maybe a growing waitlist, that people actually want this thing? And finally, how quickly can they build and adapt?
Okay, so moving on to the seed stage, now things get a little more concrete. The product is actually live, and guess what? There are real users. The company might even be bringing in its very first dollars of revenue. The story is starting to get backed up by a little bit of data. So to put some real numbers on this, here are the typical benchmarks you'd see in the US market. A pre-seed company might get a valuation somewhere between $3 and $8 million. A seed stage company, maybe $8 to $20 million. Now, keep these numbers in your head, because we're going to come back to them and see just how different things can look over here.
All right, let's fast forward a bit. The company has made it through those tough early days, and now it is all about growth. And this is where that valuation equation really starts to shift. It goes from being an art based on stories to becoming much more of a science, driven by cold, hard data.
The Series A round. This is a massive milestone. It's the signal that the company has found what we call product-market fit. What does that mean? It means they've proven that a real market desperately wants their product, and they've figured out a repeatable way to grow. The risk here has gone down significantly.
After that, you get to the Series B and C rounds, and these are all about one thing: pouring fuel on the fire. The business model works, so the goal now is just to scale it as fast as humanly possible. This is when the big institutional investors get involved, and they start writing much, much bigger checks to go and capture a huge chunk of the market. And at this point, a new metric becomes pretty much everything: annual recurring revenue, or ARR. A Series A company might have, say, $1 to $5 million in ARR, and you'll see valuations jump into that $25 to $80 million range. By the time you get to Series C, you're looking at valuations well into the hundreds of millions, maybe even over $1 billion.
Okay, so we've got the US benchmarks, right? The numbers that dominate all the headlines, but what does this actually mean for us, investing right here in Asia? Well, let me tell you, it's a very different ballgame.
And this is so important. You cannot just copy and paste US valuations onto Asian startups. Our markets operate under a whole different set of rules, and understanding these differences, that's the key to being a smart investor in this region.
So why is it so different? Well, for starters, venture capital funds in Asia are generally smaller. The market is also incredibly fragmented. You've got different languages, different cultures, which makes it way harder to scale. And historically, the final sale prices, the exits, they've just been lower. For an investor, this often means you can get in at more reasonable prices, but it also might mean a totally different path to a big win.
Let's make this crystal clear. Remember that US pre-seed valuation we talked about, the $3 to $8 million? Well, here in Southeast Asia, the benchmark is closer to 1.5 to 4 million. That is a huge difference, and it reflects all those structural realities we were just talking about.
So let's get even more specific. Think of this as your actionable map.
A pre-seed deal in India might be valued at 2 to 6 million. A typical seed deal across Southeast Asia, probably in that 4 to 12 million range. But notice this. For the really strong deals in a major hub like Singapore, the valuation can actually push up towards US levels, hitting 10 to 20 million. So location and quality matter a lot. All right, so we've covered the stages and the really important regional differences. Now let's equip you with the toolkit. What are the fundamental drivers that push a valuation higher or lower, no matter what stage it is or where in the world it is?
These are the 5 big levers. First, revenue growth. Pretty simple. How fast is the company growing? Second, net revenue retention. In plain English, are customers sticking around and, even better, spending more over time? Third, gross margin. How profitable is every single sale? Fourth, that market size story. How big is the opportunity really, and is it believable? And finally, the overall economic climate. A company raising money in the bull market of 2021 would get a very different valuation than it would in 2023.
At the growth stages, this is the math that really matters. A company's valuation is often just its annual recurring revenue times a multiple. And that multiple, it is almost entirely determined by how fast the company is growing. A company that's doubling its revenue every year gets a premium 10 to 15x multiple, but one that's growing at less than 30%, maybe only 3 to 5x. Growth is king.
So why on earth are venture capitalists willing to pay these high prices for growth? Well, it all comes down to a really important concept called the power law. You see, VCs know that most of their investments are actually going to fail. They're not trying to get a bunch of small wins. They are hunting for that one massive outlier that can generate returns big enough to pay for all the losses and then some.
This is what they're looking for. The one company that changes absolutely everything for their fund. They're not trying to avoid strikeouts. They are swinging for a grand slam. And that is why they are willing to pay a premium for a company they believe has a shot at becoming that one fund-returning winner.
If you take just one thing away from all of this, let it be this. The entire journey of a startup's valuation is a trade-off. It starts as a really high-risk bet on a story. And then with every single milestone, the first user, the first dollar of revenue, hitting product market fit, the company provides more proof, the risk goes down, and so the valuation goes up. So, we've gone from the art of a founder's story all the way to the science of growth metrics. We've looked at US benchmarks and compared them to the reality right here in Asia. You now have the toolkit to look past all the hype and really understand the numbers. So the real question is, now that you're armed with this knowledge, where will you find the next great company?